All right, so welcome everybody to the home buying seminar. My name is Joshua Puranen. I am the real estate loan originator for FreeStar Financial Credit Union. I've been doing real estate lending in some capacity for the past 12 years, but specifically it's been my primary role at FreeStar for the past 4 or 5 years. I don't know the exact date. And so we're going to walk you through the home buying process today in this webinar. First of all, I'm going to share my screen with you. Really appreciate you guys joining today, and hopefully we can answer some questions and have a productive session today, and everybody can learn a lot. Let's see if so the first thing I want to make sure that we're doing is everybody has their microphones muted and that we're saving all questions for the end. We will answer questions towards the end. Can everybody see my screen here? Are we good? Great. All right, so welcome to Home Buying 101. We're going to talk about a few different things today in the process in general. We're going to talk about getting ready, the very first steps in getting to talk to a mortgage officer, what you should do in preparation for that conversation. And we're also going to be talking about getting pre-qualified and then what happens during the mortgage process. Number one thing that you should know is that you should consult a mortgage advisor or a mortgage consultant before you talk to a realtor. This is really important, especially in today's mortgage climate and home buying climate, because by the time, if you go to look at a house with a realtor, by the time that you see that house and you think you might want to make an offer, we got people joining in. Great. So by the time that you welcome, and by the time that you actually see that house, if you go to make an offer on that house, it's already too late if you don't have a pre-qualification, because they're not even going to look at your offer unless you have that pre-qualification, because there's probably 10 other offers on that house. So it's really important that the first step that you do is talk to a mortgage originator. In preparation for talking to a mortgage originator, you should really know where your credit stands before you even talk to them. So that way, if there's any issues, you can get them out of the way. A great way to get a copy of your credit report, and really the best way, is to go to annualcreditreport.com. This is the only official site sanctioned by all 3 bureaus that you can get one free copy from each bureau a year. You can do it one at a time, Equifax, wait a few months, do Experian, wait a few months and do TransUnion, or you can pull them all at once. They generally are pretty close to the same, so you could probably just pull one at a time if you're doing monitoring over a long period of time. But if you want a comprehensive look at your credit and anything that might be on there, you should pull all 3 at once. Now, it's important to note that pulling your credit report through annualcreditreport.com will not give you a score. There is an option to pay where it can give you a score, but it's really not necessary. Really what you're looking for is derogatory events and anything that might be a surprise. If you're looking for a score or an estimate of your score, FreeStar Financial Credit Union, our website actually has a score tracker right through once you log into your online banking, and it'll give you an estimate of your credit score and give you tips on how to repair your credit or build your credit to make it better. It can give you very specific areas of improvement, so that way you can target exactly what will impact your credit score the most. And as we mentioned before, credit scores through Annual Credit Report are not free, but you can get an estimate through the FreeStar's website for free. So let's talk about tips to improve your score. Number one, ensure your credit bureau is accurate. There can be a lot of things from your past that you have paid off. Maybe you had some charge-offs and you made some payments that aren't reflecting on that new bureau. Institutions are really quick to report your information, but not delinquencies, but not really quick to correct it after it's been paid. Additionally, you might have some medical bills that you weren't aware of. A lot of times you might not even get a medical bill in the mail until it's too late and it's already showing up on your credit. So a lot of people are surprised by that. Or phone bills, old phone bills, wireless services. The next thing you can do is focus on bringing your currently delinquent loans into account. So if you have anything that's currently delinquent, you'll be able to see that and bring that into a current status. If you are currently delinquent on a trade line, It's not always a guarantee that you're going to be declined, but pretty much it's going to be a decline. So you want to make sure you have at least 6 months and preferably a full year of perfect repay before you apply for your mortgage. Number 3, pay down your credit cards first that are near their limits. So one thing that impacts your score the most is the how much of your revolving availability that you're using in terms of a percentage. So if you add up all your credit card balances and all your limits, you ideally want to be using less than 25% of your total credit card limits. And that will provide you the best opportunity to get a good credit score. Make sure that you pay down your revolving balances across all your lines, but do not close these accounts. One of the things that they look at for credit scores is how long you've had accounts open. So if you've had a credit card that's been open for 10 plus years and then you pay it down to 0 but close it out, that will negatively impact your score. Another thing that you can do, and this is something that you might want to do several months prior to applying. If you know that you're going to be buying in the spring, you'd probably want to do this step now. And that's if you have many different store credit cards, let's say you have like 6 different store credit cards, Home Depot, Victoria's Secret, Kohl's, etc. You would want to move all those balances into one installment loan, preferably here at FreeStar Financial Credit Union. That'll do several things. Number 1, you're going to get a nice low interest rate on it. Number 2, you're going to consolidate all those minimum payments into one payment, and likely it's going to be a lower payment, therefore increasing the amount that you can get pre-qualified for in your mortgage. And number 3, rather, it's also going to increase that revolving availability as well, which will help improve your score. As we were stating before, you want to do that in several months, probably 5 to 6 months ahead of the time that you plan on applying, because you want to give time to pay that down. And additionally, number 6 is that you don't want a lot of new accounts, and that would be a new account. So in the way that it can help you, it also can hurt you by opening new accounts. So if you're thinking about purchasing any furniture or anything in preparation for the home, make sure that you take it one step at a time and you complete your mortgage before you start financing furniture. So it's really important to have good credit before you go to apply, because your credit score determines your rate, which determines how much money you're going to be spending over the life of the loan. So on the screen, we have an example of how much bad credit can affect how much you pay over a period of time. In this example, we use a $150,000 home loan paid over a 30-year term. With good credit, you'll end up paying $85,011.31. Now, most of the time, people don't pay over 30 years because they sell their home or they refinance. So it's not likely that you would pay that exact amount or stay in a mortgage for 30 years. But we'll use this as an example. So if you had tier 1 credit, that's how much interest you would spend. If you had tier 2 credit, so this might look like maybe a 701 credit score, it would cost you an additional $3,720.54 in interest, with a monthly payment difference of $10.33. So not a big difference to go that next tier down, but you can see in tier 3, now there's a big difference, $11,000 difference, which is pretty significant considering it's only a $150,000 loan, and the payment difference is $30 a month. And then down from there, tier 4 credit, this might look like mid 600s, maybe a 640. That's a $41 difference. And then tier 5, a $52 difference. And now we're talking about, close to $20,000, which I think is, I mean, you could buy a nice used car for that. So outside of just credit score, there are some other factors on your credit that could affect your eligibility of just getting the mortgage. And these would be major derogatory events. Looking at a bankruptcy, a Chapter 7 or a Chapter 11, you would have to require, Fannie Mae in conventional loans requires that you have a waiting period post-bankruptcy. So the standard waiting period would be 4 years. Bankruptcy for a Chapter 13, you'd be looking at 2 years from discharge, and if you dismissed, it would be 4 years. Multiple bankruptcy filings. So if you had a couple like Chapter 7 and Chapter 13 within a shorter amount of time, it would be 5 years if more than one filing within the past 7 years. If you had a foreclosure, whether it's just a foreclosure or a foreclosure in a bankruptcy, 7 years. Or deed in lieu, pre-foreclosure sale, charge off, or short sale. This is where you sell your home for less than what you owed on it, and the financial institution takes a loss. In that scenario, it would be a 4-year waiting period. Now, I don't want to be misleading. I do want to be clear in that there are exceptions. You can see in the final column there where there are extenuating circumstances where they can go for a shorter period of time. And this might be, for example, if you were a co-borrower on a mortgage and the primary person making the payment had passed away, that may be considered an extenuating circumstance.
Josh, you're muted for some reason.
Okay, should I go back a screen?
I would, just to make sure.
Yeah. Did we miss this whole screen?
No, you just became muted when you got to the other screen.
The student loans?
Yep.
Okay. Yeah, so for student loans, be aware how much student loan debt you have. I think that student loans are very common these days. A lot of people take out massive amount of student loans to go to school, myself included. If in most of the time people are in some kind of deferment plan, particularly during COVID right now, people are showing no payment or zero balances. And if there is a no payment reporting on your credit report, then the lender is forced to use 1% of your outstanding balance, which in most cases is not actually would be your payment. If you're doing an income-based repayment, income contingent repayment, graduated payment program, that it would likely be less than 1% of your loan balance. So in preparation for applying for your loan, I would say 30 to 45 days ahead of pulling your credit, you want to make sure that you're getting the lowest payment that you can from your student loans, which will maximize your pre-qualification amount. You can buy the most house that you can get. So you'll contact your student loan company and your servicer and you'll say, hey, I really want the lowest payment. I'm getting a house soon and I want to make sure that I can get the lowest payment. And then you'll get a letter from them, like a loan verification letter from them that you can present to your mortgage officer. So that way you can be prepared ahead of time. I wasn't still muted through that, was I?
Nope, you're good.
Good. Okay. So another thing to consider is being a cosigner. So being a cosigner or a co-borrower on a debt, what that means is that you are equal borrower. You are the borrower just as much as the person that you're co-signing for. You're not a backup. You are a co-borrower. So one thing that you should ask, a couple things that you should ask is, if I had to make these payments on this loan, could I afford it? And number two, how would this affect me from obtaining other types of credits? So we look at debt to income, which we're going to break down in the next section here. And every item that you co-sign for is going to impact how much you can get approved for. So one thing that my father always told me, if you're going to co-sign or lend money to a family member, just have the expectation that you're not getting that money back. And that's the same expectation if you're going to co-sign, that you are the one buying that car. So as far as debt to income ratio is concerned, this is a banking term. And what they do is they take your total monthly debts. This would be your car payment, your credit card payments, your student loan payments, any other debts that you have. This isn't including insurance or phone bills or utilities. And then they divide that among your your gross monthly income. So that's your income before taxes. And generally, they want to stay at a ratio of less than 43%. I would argue that 43% is still pretty high. They will approve higher than 43%, but that's no way to live. You definitely don't want half of your income going out to debt. You're going to be living hand to mouth in that situation. Generally, you want to be definitely under 40%, but in certain circumstances, perhaps where somebody's in a higher income range, maybe 120 or above for household income or 150 or above, their discretionary income is going to be larger because there's certain things like food and heating a home that are somewhat stabilized across all income levels. So there are exceptions. However, it's a good rule of thumb to be less than 43%. So in this screen, we have an example of a debt to income ratio. This might be a typical scenario. This is for this is $48,000 a year gross, or $4,000 a month. And we have a couple student loans on here with a 1% payment. We have an auto loan, a modest, looks like a used auto loan, $250 payment. I think that's pretty average, maybe even on the low side. Let's say you had a FreeStar credit card with a balance, and then maybe you have a Sam's Club with the balance. And if we fit a mortgage in there, that's what the payment might look like. So in this scenario, this person is at 43%. So you can see how easy it is to get to 43% based on this is somewhat modest situation here. So based on an annual income, what should my mortgage payment be? Approximately, you wouldn't want just your mortgage payment alone shouldn't exceed much more than 25% of your monthly income. As I stated before, there can be exceptions to this. Perhaps actually in this scenario, perhaps that you didn't have any other debts, any other student loans or any other credit cards. Maybe in that scenario, they might exceed 25% because you don't have a lot of other debt going on. So let's talk about maybe we take an annual gross salary of $50,000, which would break down to a monthly gross amount of $4,166. And then at scenario, 25% of that would be $1,041. So with good credit, this would buy you about a $150,000 house. And then you would be financing 90% of that $150,000. And then this payment would also include escrow and PMI. And what's escrow and PMI? Well, we're going to get to that later. I'm glad that I asked on your behalf. So mortgage down payment. How much do you want to put down on the purchase of your home? So there's several different options. One that isn't listed on here is, let's say you're doing a VA or USDA home loan, which we're not offering at this time, but we will be offering VA loans soon enough. There is a 0% option for that. Mind you, if you're putting less of a down payment on a home, your payment is going to be higher because you're financing more of that purchase. For first-time home buyers, which would be defined as home buyers that have not owned a home or been on title of a home in the past 3 years. So perhaps if you are on title of a home as a backup for somebody else, that would actually disqualify you. Or if you had maybe a second home, but you didn't have a primary residence, which I don't know many scenarios that would happen, but people do that, that would count. Or maybe you sold a home, but you haven't 2 years ago and you've been renting. So in that scenario, you're still not a first-time home buyer because you haven't been without home ownership for 3 years. Now this doesn't mean to say that every first-time home buyer qualifies for 3% down. They're still going to look at credit. They're still going to look at other things. But it's a great program, and it's really competitive with the FHA, which is 3.5% down. For repeat buyers, let's say you own a home and you're selling a home and you're going to buy a new one. In that scenario, you can get as low as a 5% down payment. And let's say that you had maybe some credit derogatories in the past. Your credit score isn't that great. Maybe you're at a 650 or up, lower sixes. In this scenario, the financial institution is going to want a little bit more skin in the game. They want you to put a little bit more down to compensate for that risk. And then that might be as much as 20% down, depending on how bad your credit is. And then it says no PMI. So if you put, sometimes people, if they're selling their home, and let's say they're selling their home for 200,000 and they're walking away with 100 grand profit, and so they have a large down payment to put on their next home. They could maybe put 30% down, but they might only choose to put 20% down because they're just trying to avoid the PMI. So what private mortgage insurance is, it's an insurance that you pay if you have a smaller down payment. And we're going to talk a little bit more about that. One thing of note is that down payments must be documentable. So if you're keeping cash in a coffee tin and burying it in the backyard, or you keep money in your safe because you don't trust the banks, you really got to get that money in the credit union or the bank or somewhere that we can document it through monthly statements. So if it is in a safe at home or underneath the mattress, bring it into the credit union, wait 2 months because we have to show 2 months bank statements, and that way it'll already be in the account. They're just looking to make sure that you're not using drug money or money laundering. So we're required to document that. And all institutions are required to document that. So whether it's through FreeStar or anybody, you got to show those bank statements. Now, as of note, I should say a common thing that I've been seeing lately, particularly among millennial buyers or younger, is that people have a lot of money invested in cryptocurrency. And it's important to say that, yes, you can use cryptocurrency to purchase a home. My suggestion would be that several months ahead of doing your purchase, that you do liquidate those funds into a bank. So that way you're not taking the risk of fluctuating that market value of that cryptocurrency. And then you had $30,000 and then a week later you have $20,000, which we all know cryptocurrency can be like that sometimes. So just for making sure that you stabilize that asset, I would move it into a bank account ahead of time. Now, if you're doing that within the 2-month frame before you apply for your mortgage or before you buy your house, we will have to show paper trail of that. And a lot of times through these cryptocurrency services, they do offer actual PDF principal statements, so that is possible. Mortgage payments. So the way a mortgage payment is broken down is there's usually 4 to 5 parts of a mortgage payment. So principal and interest is the first part. Principal is the amount of money that you borrowed. And then interest is the fee that you pay back to the financial institution to borrow that money. Escrow payments. So there's the escrow account is your homeowner's insurance and your real estate taxes. And the mortgage servicer collects those within the payment because we have stake in making sure that those are getting paid. If the home isn't insured and a tree falls on it, we want to make sure that that home gets fixed. So that way it doesn't devalue the home or you don't move out because you don't have enough money to fix it. And also with real estate taxes, we want to make sure that home isn't foreclosed on taxes and then we lose our lien to the county or we lose lien position. Private mortgage insurance, which we briefly touched on earlier. If you're making less than a 20% down payment on a conventional loan, they're going to charge an extra premium a month. The approximate mortgage PMI payment is, this is a ballpark figure, about $75 per 100,000. So if you had a $200,000 house, it's $150 a month that you're not really getting anything for. And what it does is if you do default on your home, then the institution that lent you the money would get some, but not all of their investment back. So again, the screen, if you're putting less than 20% down, PMI premiums are added to your monthly mortgage payment. Now, the good news about PMI is that it's not forever on a conventional loan, as opposed to an FHA loan where you do pay it forever. If you pay down, there's 2 ways that you can gain equity in your home. Number one is that you pay your principal balance down and then that is you buying equity into the home. Number two is that the market value of your home increases. And generally, you gain equity in your home faster through market value increase than you do paying your principal balance down. Once you achieve that 20% equity, you through market growth, you can actually pay for an appraisal and use the new appraisal to remove your PMI. So typically you might pay PMI for 10 or 11 years if you did nothing, if you just sat on your hands. But if you watch the market value on Zillow and it goes up, if you paid for at a rate of market increase at 8% a year, it would really only take you, 3 to 4 years to remove that PMI, which is actually what I did on my home. Now, on an FHA loan, which we do not currently offer, that PMI never comes off, and you would have to actually refinance that loan to remove the PMI. So here's a couple examples of mortgage payments, just to give you what a mortgage payment might look like for a couple scenarios. This is for a 30-year fixed rate mortgage. On a $100,000 mortgage at 4% APR, which is actually kind of high right now. We're actually in the low 3s or 3% for a 30-year purchase with a 20% down payment. In this scenario, principal and interest for a $100,000 mortgage would be $477 a month, $200,000, just under $1,000 a month. Homeowners insurance, assuming your homeowners insurance is approximately $900 a year for a $100,000 mortgage, or $1,200 a year for a $200,000 mortgage. And then the escrowing for taxes, $2,000 annual property taxes between summer and winter would equate to approximately $167 a month, and then $315 for a $200,000 mortgage. Now, I should note that actually these property taxes are relatively low for these home prices, and probably for a $100,000 mortgage, you'd probably see something more like $2,500 a year. Maybe the $3,200 is probably closer to $3,500 for a $200,000 mortgage, but these are some rough figures. For PMI premium, maybe $63 a month for a $100,000 mortgage, or $120 for a $200,000 mortgage. So you can see about $800, $782 a month, $800 for a $100,000 mortgage, and then a $200,000 mortgage, you're looking at $1,500. Now, this isn't a $100,000 purchase price. This is $100,000 after a 5% down payment. So this would be about $105,000, $106,000 purchase price for the first example, assuming that it's not imperfect credit, maybe a 680 credit score and 38% DTI. All right, so we gave you some things that we're going to look at in the consultation process, or some things that you're going to look at on your own to kind of pre-budget and get an idea of what you can kind of pre-qualify yourself as a reasonable expectation of what you're going to get pre-qualified for. So now you're going to talk to your lender. Before you look at your new home, always contact the lender first before you contact your agent. You want to gather documentation ahead of time. Although FreeStar Financial Credit Union will issue a pre-qualification off of stated income, I don't recommend doing that, because we want to make sure that we're using reliable numbers, because the more accurate information that we can have, the more accurate pre-approval you're going to get, and the more confidence you can have in making an offer. So you want to get pay stubs ahead of time, W-2s ahead of time. Especially important if you're self-employed. We want your 2 previous years business and personal tax returns, because it's hard to judge self-employment income without seeing that. A lot of times the people will tell us what their revenue is and not what their income is, which there is a big difference. Pre-qualification letters will outline the terms and loan amounts that you are pre-qualified for. So it'll say specifically this person is getting a 30-year conventional mortgage, or a 30-year VA loan, or an FHA loan. It'll tell them what product they're using and the term as well. And it'll also say how much down payment that you're looking to put down. I have, in some scenarios, issued multiple pre-qualification letters to the same person. Sometimes they don't want to show all their cards to a listing agent, and they don't want to show that they're pre-qualified for $300,000 when they're making an offer on a $200,000 home, because the seller, that puts the seller at an advantage knowing that that person can afford more. Pre-qualification letters are generally good for 90 days. So after that, the credit report is not as good. It's expired, and a lot of things can happen in 90 days. Renewing a pre-qualification letter is generally as easy as pulling a new credit report, providing that your employment situation or other factors haven't changed. What factors go into a mortgage approval? Number one, income and employment. So one of the first things that I ask in a consultation is, are you currently employed? Which is not a requirement, but it's good to know where somebody works and how long you've been there. I generally need to have 2 years of stable employment, preferred at the same place, but not necessary. An example that may be acceptable employment history that's not 2 years consistent, same employer. Well, let's say you're a nurse and you haven't stopped nursing. You've been nursing for 20 years, but you just switched from Beaumont and you got an offer accepted at, I don't know, St. John's or something like that. And in that scenario, we would just get a letter of employment showing what your new pay scale is and when your start date is and how many hours that they're going to guarantee that you works. So if you're staying in the same industry and you just switch employers, it is possible that we can still get you pre-qualified. I've done that with people moving from state to state. Maybe they work in IT and they were working in a different state. Now they moved to Michigan. So it is possible for us to do that. They want to make sure that your income is consistent over a period of time. So a lot of people that work commission jobs sometimes can fluctuate. So if you just started a commission position or you're highly bonus or overtime dependent in your employment, we want to be able to show that you've had consistent W-2s over a period of time. So if your 2019 was really good, but your 2020 wasn't that great, they're going to take more of an average or a lower of the two. We want to make sure that your income is consistently increasing or staying the same. Oh, got to go back. So as we discussed earlier, credit score and repayment history is definitely important. We want to make sure that you make reliable payments over a period of time. The credit score is going to impact your ability to get the mortgage. It's going to impact the payment because it's going to impact the rate. We want to make sure that we're going to get reliable on-time payments. Also, liabilities. This is items that are on your credit report. So this would be, how much do you owe for your car payment? How much do you have outstanding in credit card bills, student loans? How much money do you have out there that you owe? Is it a lot over a lot of different places? Credit cards, the thing about credit card debt or unsecured debt is that it's unsecured, so it's riskier. You're more likely to default on it. So let's say you didn't have a car loan, but you had $30,000 in credit card debt. Well, that's actually riskier than a car loan because it's easier to walk away from that credit card loan than it is your vehicle, because you're going to have your vehicle taken away if you don't make that car payment. So it is a little bit riskier to have more unsecured debt. Additionally, those liabilities affect your debt to income ratio and your ability to afford a payment. Assets, really important. So if you want to buy a house, the thing that's going to help you the most outside of credit and income is, how much money do you have? How much money have you saved up for a down payment? How much money have you saved up for your closing costs? How much money do you have saved up for the day that you turn the key on your new home and you walk in? How much money you're going to have in your bank account after you paid for your down payment and closing costs? A lot of people don't think about reserves, but I'll tell you, it's really important. You don't want to be broke on the day that you move into your home, because owning a home is great, but a lot of things can go wrong, particularly when you first move in, because you don't know that home. You haven't learned its quirks. Maybe your furnace goes out within the first couple of months. That can be an expensive fix. So they're looking for reserves. They're looking for a down payment. They're looking for money for closing costs. And the more money that you have saved up, the better it is and more stable you are, and the better you present to an underwriter. Also, collateral. This is the home. The home is used as collateral. So they want to make sure that the home is worth more than what you're borrowing. Particularly in this this home buying market, people are offering over asking price in an effort to secure that home. So if you're offering $10,000 over asking price, now that loan, even if you were putting $20,000 down, that $20,000 is not quite a highest percentage of a down payment, and therefore you might actually have to put a little bit more down because maybe they're only willing to lend up to 92% of the value of the home. So we want to make sure that home appraises for what you're borrowing, and additionally, we want to make sure that home is safe as well, and that it has a certificate of occupancy that you can live in it. So down payment and closing costs, big difference, and you have to pay for both. I think a lot of people underestimate how much closing costs are, how much it costs to do a mortgage, and how much it costs for all the other things that go along that you have to bring to closing. So there's a difference between fees and costs. Fees are charged and collected by the lender. This would be an origination fee or a closing fee if it's a refinance. Costs are charged by a third party and are required for the transaction. So not all the money in closing costs goes to the lender. Most of it actually goes to vendors. So a closing fee on a purchase would actually go to the title company because they're the ones that's going to you're going to go to the title office and sit down with a closer, and they're actually employed through the title company. The appraisal, right around $475 up to $600 for an appraisal. That's a person that has to do a job and they have to get paid for it. Also title insurance, which is on every single mortgage done. And every time you do a mortgage, they're going to insure that title and they're going to do that background. And a title insurance can cost generally anywhere from $600 up. And especially if you're getting into $200,000 mortgage, it can cost almost $1,000 or more. If you're going to pay for an inspection, which isn't always required, you're going to get an inspector of your choice to come in and check out the home for any water damage or anything like that, termite damage, that you have to pay for that as well. There's also recording fees. Typically, there's a compliance fee charged by your realtor. And generally, fees will change from lender to lender, but third-party costs are relatively the same because they're vendors. So where you're going to find a competitive advantage in shopping is what the lender is charging for their services, not necessarily what the title company is charging. So you went out shopping, you found a house, you make an offer, and they accepted your offer. Well, now what? Well, now we're going to go into processing. Now your pre-qualification turns into an application. And things to remember while you're going through the process of getting a mortgage: start shopping for your homeowner's insurance policy as soon as possible. Do not buy new furniture yet. Do not open new credit. New credit may disqualify you from obtaining a mortgage. Those new payments could potentially affect your DTI, which could knock you out of the running for buying that home. Pre-qualification is not 100% guaranteed. Sometimes things pop up in the underwriting process that could stop us from buying this house. I've seen it before where there's title issues with the home. Maybe the seller didn't have the right to sell the home for whatever reason. There's some weird examples of that. If your financial situation changes, maybe you change jobs, which I've had that before. Somebody changed jobs on me and didn't tell me through the mortgage process, and it knocked them out of the running for getting that. It was a different industry that they went to. And then they make sure that you get requested documentation in properly. So it seems like when you're buying a home, your mortgage officer is going to ask for 10 different things, and you get them in the next day, and then it seems like nothing happened for a while. And then all of a sudden they call you a week later and they go, oh, I need this, this, and this, and I need it today. There's a lot of hurry up and wait in the mortgage process. So just understand that that's normal. No matter what institution you go through, they need everything and they need it right now. And then you might not have any movement on your file for a while because we're waiting on vendors to respond. So how much money are you going to need? And what for? So kind of touched on this earlier. Down payment, this is a percentage of the purchase price. 3 to 5% of the home price or more, depending on your credit. Closing costs. Generally, I'm going to say that to give you a ballpark figure, this is just a random figure based on what I'm seeing homes are selling for now. Closing costs between escrow funding, et cetera, you should be prepared to come with like $7,000 to $10,000, maybe $12,000, depending on the price of the home. Escrow deposit is included in that number. So you have to pre-fund your escrow account. So that way, by the time your taxes are due, we have enough. If winter taxes are coming up due in December, so if you close this month, we would only have a couple of months to collect before it's all due. So they would collect, in this scenario, maybe 10 months, and then you make 2 payments, and then you have enough to pay, and then we have enough to pay them in December. Tax prorations. This is paying the seller of the home back for the taxes that they already paid. What's not on here is a water bill. Sometimes you have to pay back, well, always you have to pay the seller back for the portion of the water bill that they already paid. And then homeowners insurance. At FreeStar, we do have you pay the first whole year premium up front, which can be anywhere from $800 to $1,500, depending on the how much your insurance you're getting, where the home's located, et cetera. Getting ready for your closing. So in preparation for your closing, expect the mortgage process to take approximately 30 to 45 days from the date of the purchase agreement that they receive it. Know how much you need to bring closing, which should be a clear conversation throughout the mortgage process, that your mortgage officer is being very transparent with you with exactly how much you're going to need in preparation for that closing. And make sure you're not spending a bunch of money. You want to make sure that you're keeping as much in your bank account as you can, and you're not making large purchases or doing large money transactions that might cause red flags. Review all your documents. There should be no surprises at the closing table. If you show up and say, "I didn't know about this," it's kind of also your fault, to your responsibility, I should say, to read all the documents that are presented to you. They do offer a closing disclosure 3 days ahead of the closing, so you have plenty of time to read exactly what you're going to be closing, what you're going to be signing on closing day. Make sure you ask tons of questions along the way. There is no stupid questions. The stupid question is the question that was left unasked. And as always, expect the unexpected. There are going to be many surprises in your home ownership journey. So just expect that it is a bumpy road. It can be stressful at times. That's what makes my job interesting. And it's a different day every day. I can tell you, there's always different scenarios. So we do appreciate your time today. Does anybody have questions? We're going to field some questions now. I'm going to bring up the chat here, see if there's, I don't know if it's been going on during this whole time. Are you there, Lori?
I am here. So far, no questions.
So here I am.
I have a question.
Sure.
Thank you. I apologize if I'm supposed to use the chat and not the speaker feature.
No, this is fine. Yeah.
Okay. If you're, as far as the student loans, if you're still in school, like working on your master's degree, and you're not having to pay your loans right now, do you still need to disclose that?
Yeah, that could be a little bit more difficult scenario. You would definitely want to disclose that to your lender. What I would do in that scenario is I would reach out to your student loan servicer, and you can still get a letter. Generally, you can ask for a letter. What we're looking for is we want to have a reasonable expectation that you're not going to have a payment for X period of time. So if we can get something through your your student loan servicer showing that your payment's going to be zero or a very low payment for the next 12 months, we can use that.
Sounds good. Thank you.
It can be difficult while you're in school because there's generally it's only a 6-month deferment.
Right.
So that can be, but if your student loan servicer is able to provide that student loan payment showing over a year out, that's generally what we're going to need.
Perfect. Thank you. I appreciate you.
Yeah. Thank you for asking a question. That's a good question too. Oh, maybe Jacob has a question here. He's typing. Is it common to get the seller to pay closing costs? This is a great question. And I would say in this market, the answer is no. In this market, the answer is no. It's not impossible. However, because home purchases are so competitive right now, there's limited inventory and lots of buyers. Generally, if you have two of the same offers and one's asking for seller's concessions and one's not, they're going to go with the one that's not. So in a multiple offer scenario, it's unlikely that that would happen. Now, I did purchase my home with seller's concessions, but I did that in 2011 when there wasn't it was the opposite scenario. There was tons of houses and not a lot of buyers. So I offered full price with seller's concessions, so I got a little bit of a discount. Now, that is if you're limited on funds to close. Let's say you don't have a lot of assets. In that scenario, we could still get you pre-qualified, but there would be a stipulation on your pre-qualification letter saying with 3% seller's concessions, which when the seller's presented with that, it makes your offer less enticing. So the answer is yes, you can get that done, which would lower your closing costs, allowing you to buy more home with less money. However, in this current market, I would say it is not the typical scenario. Does that answer your question?
Josh, Dion also has a question.
Yes, Dion.
Or Dion raised his hand. Did you mean to raise your hand, Dion?
I'm a disabled veteran, and I will not have to pay taxes on my home. But I was wondering, should I still pay the taxes, or should I put it in a savings account?
Yeah, so if you're 100% disabled in Michigan, you don't pay the disabled veteran, you don't pay those property taxes. So I would not put them in it. I mean, no, I wouldn't pay the taxes, but I guess if you because you're not required to, but you got to make sure that the municipality in the county that you live in recognizes that you're 100% disabled. You actually have to apply for that. So I have seen it before where they assumed they didn't have to pay it, and they didn't actually file the proper paperwork, and they ended up having to go back and pay that. I think they were reimbursed, but it took some time. I guess if you have the money to save, it's always good to save, but not required, right?
Right. So I would rather save it every year. So, like you said, if the furnace breaks down, I would have that money for something like that.
Oh, sure. It always helps to have those reserves, because in home ownership, you never know what's going to happen, right? Life just happens to us sometimes. Sometimes it's like that, right? Appreciate the question. Anybody else? All right. Well, Lori, do you want to wrap this thing up, or?
You are all set, Josh. Thank you.
We got another question. Thank you, Stephanie. Yes. Yes. What is considered a good credit score? Well, I think everything's relative in life, right? So a 680 for one person might be a really good credit score, but a 680 for another person might be really low. I'll tell you that the minimum score to get a conventional loan would be a 620. However, I don't see a lot of 620s actually get approved. There's a reason why your score is a 620. Generally, I consider the top tier is 741 and up. So whether you're an 800 or a 750, it's the same rate. Also, I would say generally anything over a 700 is pretty good. That's where you want to be in general. At a 701, you probably have a delinquency on there, and it might be from a few years ago. If you have something within the past, one late payment or two late payments within the past year, it's probably going to be in the low sixes. If you have charge-off, collections, repossessions, you're probably going to be within the past 2 to 3 years, you're probably going to be a sub 620. So if you have any of that stuff, you want to make sure that you clear it up, get paid up as much as possible, and get those items removed from your credit report, not just showing as paid. Because if you pay off a collection or a charge-off, it will still appear on there, which still affects your score even though you paid it. So it just helps a little bit more to pay it. Generally, What I see get approved, I would say 650 and up. You can get approved with, maybe a 640, but there's other compensating factors. Like maybe you're putting 40% down on a home. You're coming with a ton of cash, or maybe you make a lot of money. Maybe you're making 120 grand, 6 figures a year, and that payment is really low in comparison to how much the payment is, and you have really low debt otherwise. Maybe that your credit score was really low from some kind of black swan event that affected your score. Maybe you had a few late payments, or you had some medical issues that took you out of the game for a minute, but now you're back up and rolling, and all the other factors are good. In that scenario, maybe a lower credit score would still get approved. However, you pay for it in the rate. Hopefully that answers your question. In general, I would say 700 up is, I think, pretty good credit. If you ask somebody that was really particular about their credit score, really proud of it, they would probably not be happy with the 701. But I think that there's people out there that maybe came from a bankruptcy that would be happy with the 700. So in general, you're going to get a decent rate with a 700 or up. Does that answer your question? Yeah. Awesome. Any other questions? All right. Well, hey, FreeStar really appreciates you guys joining in today. If you want to give me a contact, if you want to contact the mortgage department, actually, this is wrong. It's actually option 230, or you can listen to the prompts and get a hold of the mortgage department. We've been pretty busy this past couple years, but we got a full team here, and I can assure you that you're going to get some great one-on-one attention through FreeStar. And definitely give us a call if you're interested in purchasing home, or if you know somebody that's looking to buy a home. We'd love to help them out. All right. Thank you very much. You guys have a great day.